Real estate investment trusts, or REITs, offer a high-income alternative to stocks, and over the long term they've generated returns which are comparable with stocks. And yet recently there's been a brutal sell-off in REITs, and that's created opportunities. So what are REITs? What are those opportunities? And also, what are the risks with REIT investing? Now, don't forget, if you do like our content, please do subscribe to our channel. That way you won't miss any new content. So let's look at REIT investing in a bit more detail. What is a REIT? Well, it's one way to get exposure to asset classes like commercial property. So let's imagine there's a portfolio of commercial property. It might be shopping malls, and it generates income. Now, what you can do is pipe all of that income into a collective investment scheme, which is a real estate investment trust, and then all the investors in that trust get paid out a proportion of the income. So at its core, this is really a very tax-efficient way of channeling income from things like commercial property into the hands of investors. Now, one of the arguments for buying REITs rather than just more equity is that it's not highly correlated with equity. So here you can see various ways of diversifying stocks, and we can look at the correlation with the broad stock market of various different slices of the stock market. So you might go for a factor like value or growth, or maybe a sector like tech, or maybe small caps. But none of these have a very low correlation with equity in general. They tend to move up and down together. Whereas REITs, you can see, have a correlation of about 60% with equity. So they do provide more diversification than just another variant of stocks. Now, this is what I'd call a Scooby-Doo tree, but it just shows you the correlations between different asset types, such that two things which are close together on the tree, so here's a junk bond fund, HYG, and an emerging market bond fund, EMB, those are highly correlated with each other. They tend to move up and down together. So if you buy one, it won't diversify the other. Whereas if you buy from different parts of the tree, it will diversify. But what's interesting is that real estate investment trusts tend to be correlated with a risky part of the tree, which is the top half here shown in the red box. That would include junk bond funds, also emerging market debt, but also equity. So the S&P tracker, SPY, the NASDAQ tracker, QQQ, and emerging market equity, for example. But also the oil fund USO and Bitcoin. What's not true is that they're very safe, like US government bonds. Real estate investment trusts don't correlate highly with safe haven investments, such as US treasuries, but also gold. So mentally, you should account for them in the risky bucket of investments. Now, there are variations in how REITs work across different countries. And in this table below, you can see that comparison point by point. But the key point is that REITs generally pipe a lot of their income into the form of income for investors. Plus, there are constraints about what they can invest in. So in the US, they have to have at least 3/4 of their assets in real estate. And in the UK, there are also concentration limits to ensure that the portfolio is fairly well diversified. But another thing which is attractive about REITs is that they're very liquid. In other words, they trade on an exchange, just like a stock. Now, there are subclassifications of REITs. For example, the biggest category of REITs would fall into the equity category. So these are publicly traded, they trade on an exchange. They generally own or operate income-producing real estate. So when people talk about REITs, this is usually what they're talking about, equity REITs. Now, one alternative in America is to buy MREITs or mortgage REITs. These don't directly own property, but they buy the instruments like mortgage-backed securities that are used to fund purchases of property. In turn, that means they tend to be much more interest rate sensitive. But the payback you get for owning these is generally a higher income. Then the two categories below, you probably don't have to think about. These are public non-listed REITs. These are registered with the SEC, the Securities and Exchange Commission, but they don't trade on national stock exchanges. So they don't tend to be very liquid. And then private REITs are exempt from SEC registration. And usually those would only be available to sophisticated investors. And there's a nice graphic here from Visual Capitalist, which shows another aspect of REITs, which is that they can invest in different sectors. So here are the largest real estate investment trusts in the world. Prologis is the largest one, and you can see that that specializes in industrial property. American Tower, on the other hand, buys the land which is used to house mobile communications networks. So this would come under the communications category, and so would Crown Castle. So this is where you'd store stuff if you move house, for example. And it does require a lot of space, which you can fund with a structure like a REIT. Another sector would be data centers, where, for example, Google would house its servers. So you can see that you have a choice, as well as the country of where the REIT is based, about the exact sector for the property which it owns. And each of these will be differently sensitive to things like economic growth, but also interest rates. Now, I said at the outset that the return on REITs was comparable with equity, which is a pretty tall order, but here you can see the 50-year returns for mortgage REITs, that's shown in blue here, but also equity REITs. And you can see that the return's been very strong. This is a total return, so it's capital gain plus income, and generally it's been higher for equity REITs than it has been for mortgage REITs. Generally, mortgage REITs pay out a higher dividend, so for some investors that's attractive. But in terms of total return, equity REITs have done best. So if we compare side by side the S&P 500 and equity REITs, you can see that the total return is comparable. So over the last 40 years, about 11% for both of them. Maybe the S&P 500 has returned a little bit more. And since 1972, equity REITs have returned slightly more than the S&P 500. Now, the trigger for the sell-off in REITs this year has been higher interest rates. And different sectors or types of REIT are differently sensitive to interest rates. At the same time, we've seen a change in behavior over the course of 2022, such that more people are working from home, and that means there's less demand for commercial real estate in the form of offices. So office real estate has had the double whammy of rising interest rates combined with a change in behavior and a lack of demand for office space. But residential property too is very rate sensitive, and apartment REITs, but also manufactured home REITs, have also suffered a big sell-off. Down at the other end of the table, the least interest rate sensitive sectors have been things like lodging or resorts, but also specialty REITs, which are actually up year to date, and things like shopping centres, but also freestanding REITs, another form of retail REIT. Or there's a diversified category which invests in multiple different types of sector. So if you're wanting to hedge your bets, that's what you would have gone for. And it certainly worked in reducing your sell-off this year. So here are the largest 5 REITs in the UK, and you can see that here too the sell-off's been very brutal. Both Segro and Tritax Big Box, 2 of the largest, have sold off by around 50% by the beginning of October this year. But notice that many of these REITs have now bounced back since the beginning of October. This could just be a dead cat bounce or another bear market rally, but hopefully this is a turning point for REITs after what's been a very difficult year. What I've done here is to look at the sector of the largest UK REITs, and that's what you can see here in parentheses after the name of the REIT. Now notice that some of the REITs which have sold off the least in the UK are all in the diversified category, just as we saw for the US. Now there are some exceptions to that. For example, here are 2 diversified funds which have sold off a lot, but generally diversified funds have done best over the course of this year. And if we look at what's sold off worst, it tends to be things like office space, but also residential REITs. And if we look at the bounce back period since mid-October, it's very difficult to see a pattern in what's done best. So if you are going to be buying single real estate investment trusts, it's really important to look at whether they're profitable and to read their annual reports. The only exception to that would be if you buy a diversified global REIT, say, where you wouldn't have to pay so much attention. But these are not fire and forget investments. You have to monitor them all the time in case their situation deteriorates. One of the attractive features of REITs is that they tend to offer a high income or a high dividend yield. So if we compare the current dividend yield with the S&P at the moment, the S&P is giving about 1.6%, which is pretty small, whereas REITs generally offer around 4% right now. And if we look at this dividend yield column, which breaks it down by sector as of the end of November in 2022, you can see that some of these yields are very attractive indeed. For example, diversified REITs, which has about 12 REITs inside it as a category, that's generating over 6% at the moment. And if we look at mortgage REITs, they're generating more than 14% right now. If we do a comparable thing for the UK, you can see that the yields are even higher. Now be careful with this because a high dividend yield can also be another sign of a company which is in terminal decline. That's because dividend yield increases when the price of a company falls, because it's income divided by price. And if price is getting smaller, that tends to inflate the dividend yield. So again, if you are going to be buying a single sector within a single country, make very sure that the dividend yield is sustainable and that the company, the real estate investment trust, has a very brisk and growing income, and that the dividend yield isn't a sign of big problems for the REIT. But certainly for the UK at the moment, you can see that the average REIT is giving a return, a dividend yield of greater than 5%. Before we move on to talk about the risks of REITs, let me just quickly mention our weekly market roundup, which you can see beside me here. What I try to do is publish something which is short and punchy, which cuts through the noise that you get inundated with as an investor. So for example, one of the stories I talked about this week was to do with REITs being gated. If you do want to learn more about investing, it's a great way to do that, and it's absolutely free. To learn more about it, just click on the link beside me or in the description beneath me. Now, the risk of REITs is very similar to that of equity, in other words, very large. So in the UK, for example, there was an administration in a very large REIT called Into in 2020. This owned a huge amount of commercial real estate around the country. So for example, it owned a Watford shopping centre not far from where I live in Buckinghamshire. And if you'd have owned the REIT, here's its share price over time, you can see that it falls to zero when the company went into administration. So just like with equity, if the company fails, you stand to lose 100% of your investment. So that's why you have to be careful and select your REITs very carefully. Or one other way to mitigate your risk is to diversify across multiple sectors or multiple countries. Now, the story I was talking about, which I covered in the weekly market roundup, is to do with Blackstone's flagship fund, which is called BREIT or BREIT. Now that is not in a terminal decline, far from it. It's a very diversified fund, and it's usually only available to high net worth individuals. So for a retail investor like me, I couldn't have bought it anyway. But what's unusual about this fund is that it's not listed on an exchange. So it's one of those illiquid funds which we mentioned at the beginning. However, it's also not closed-ended. Most real estate investment trusts are closed-ended, which means that the amount of capital in the fund is always constant. If you sell your share, somebody else has to buy it. Whereas an open-ended fund shrinks and expands as money flows out or into the fund. Now, the problem is that the assets are very illiquid. So if it's open-ended and lots of people are asking for their money back, the manager can't sell the assets quickly enough to give them that money back. So it has to refuse redemptions. In other words, your money could get trapped inside the fund if the gates come down. This isn't a worry for most investment trusts because they are closed-ended. But if you see this in the headlines about BREIT being gated, don't worry. Just make sure that your REIT is closed-ended. In conclusion then, what's attractive about REITs is their good long-term returns. So if you do buy a diversified one, it can just sit there in your portfolio forever. The macroeconomic environment right now is looking more troublesome for REITs because we've got a combination of higher interest rates and slower growth. Both of those are toxic for real estate investment trusts, just as they are for equity. But the sectoral impacts are going to be different. So it pays to think through whether your sector and your country, where you've got exposure, are going to be negatively impacted, or they can get through this crisis fairly unscathed. What's certainly true is that the yield on many REITs at the moment are very attractive. Just be careful, like I said, that you're not choosing a company with a high dividend yield because its price is going into terminal decline. And you can gauge that by looking at the company's reports and its financials. But if you are going to buy a highly concentrated fund in a particular sector and a country, you can't just leave it alone. You have to monitor it to ensure that its fundamentals are still intact. Or another alternative is just to buy a globally diversified REIT, and that way you won't have to worry about watching it or whether its fundamentals are deteriorating. So I hope that's given you a taste of what REITs are like and the kind of environments in which they do well. But you can see it's a very diversified asset type. But what's good about it is high income, but also a little bit of diversification away from just buying more equity. So don't forget our offer. If you do want to learn more about investing, our weekly market roundup is absolutely free. And you can find out more about that by clicking on the link beside me and in the description beneath me. And as always, thank you for listening.